three of the major rating agencies released their reviews on South Africa last night. Could you please just quickly just summarize what happened? Who's done what on South Africa?
Okay, so yeah, Moody's, S&P, and Fitch all reviewed South Africa. Moody's and S&P was expected, Fitch was not. S&P kept the rating unchanged. So it's just to highlight that S&P, there's a one-notch difference between the way that S&P rates South Africa's local and foreign debt. So foreign debt is BB minus, and their local currency debt is BB. BB minus is just one notch above the single Bs for S&P. Then we have Moody's, which downgraded South Africa by one notch from a BA1 with a negative outlook to a BA2 with a negative outlook, and that's both for the local and the foreign. And Fitch has moved South Africa to the lowest of its double B ratings, so to a BB negative with a negative outlook. So that leaves Fitch with, I suppose, the worst or the lowest rating of all three for South Africa. Just to bear in mind, Moody's is now, in a sense, Moody's was behind S&P in terms of its rating, its downgrading of South Africa. And now in terms of the local currency debt, it rates South Africa worse than S&P. So it's got a BA2 with a negative outlook, which is equivalent. So the BA2 is equivalent to a BB for S&P, but Moody's has the negative outlook, BA2 with a negative outlook, whereas S&P has BB with a stable outlook. So Moody's is now sort of, I suppose, in the race to downgrade South Africa. Moody's is now ahead, Fitch is in the front, and S&P rates South Africa the best out of the local currency, and in line with Fitch on the foreign currency.
Okay, and then the downgrades presumably mainly reflect the very poor fiscal situation. Okay, can you just take us through the key comments from Fitch and from Moody's, why they're downgrading us, and maybe even add a comment there on why S&P has kept us stable?
So yeah, it's a combination of things. I suppose the rating agencies are highlighting this kind of negative circle or vicious circle that we find ourselves in, and it's, I think what all three rating agencies are highlighting is that South Africa can cut its spending dramatically. And I think, what we saw from some of the commentary is that they're quite impressed with the extent to which, so S&P in particular mentioned that they're very impressed with the extent to which South Africa is cutting its expenditure. It thinks it's very ambitious, but they all three note that even if we cut our expenditure because of our poor growth, which was a pre-COVID condition of that South Africa faced, lower structural growth versus all of its similarly rated peers. Because of that low growth, it means even if you cut expenditure, you don't have the kind of growth and revenue that you need to bring down your debt levels. And that means that your debt levels are it's very difficult for us to stabilize our debt levels through cost-cutting measures. And all that, and what we're facing now is, even as we cut our spending on operational expenditure and infrastructure, our spending on debt service costs is soaring, and most of the rating agencies have our debt service costs to revenue rising to around 25%. And that's, once you move over the 15%, that's when debt sustainability and default start to feature more with a high likelihood on the radar. So us moving to around a 25% debt service cost to revenue means that most of these rating agencies are now worried about South Africa's ability to continue its social spending. And they're also then worried about the social unrest, and I think a sort of a shift to populism that could emerge because our spending on debt service costs is going to be escalated, and our spending on public services and welfare and social protection is at risk, and that could heighten an already fragile political environment. So we're stuck with a situation where we're cutting costs, but our debt service costs are rising so dramatically that it's countering the extent to which we're cutting on the operating side. So all our cuts on the operating side can't compensate for the amount that our debt service costs are rising, which puts our ability to reach debt sustainability at risk, because we can't do it via cutting costs. We have to do it by increasing growth. So unless our growth starts to increase, none of these agencies see us being able to stabilize debt. And that means that we won't be able to contain our debt service costs, which will mean that we run into problems on the service delivery side, and that will lead to political problems and fracturing our political environment further.
So further bad news then for the markets, Kim. So as we turn our attention towards how markets can react, can we start with the issue of, were these moves expected, or do you think this is going to come as somewhat as a surprise to the markets?
So, John, I think, the only thing that's really market moving here is if we had moved into a single B. So when you're moving sort of up and down between the double Bs, that's less market moving. As you move to the cusp, to the BB minus, so that you're on the cusp of moving to a single B, that's market moving. And we've already seen S&P move us to that cusp. So in a sense, markets, I think, have already priced this the current fiscal constraints and the risks to debt stabilization. That's all already priced into our assets. So I don't think this should be market moving, although the Moody's downgrade was a surprise. I think most of that move is priced in anyway, because S&P was the first mover there.
Okay, so perhaps a knee-jerk reaction then on Monday, but no major long-term fallout in terms of flows is what I think you're saying. But we are, again, as you say, moving towards that cusp. So moving in the wrong direction, but knee-jerk reaction, but no major fallout at this stage. Would that be the summary?
Yes, and there were some positive remarks that the rating agencies made on our institutional strength, and one of the Moody's, I think it was, actually commented that they see SARB and National Treasury, as sources of institutional strength. So I thought that was very positive. Often just the SARB is quoted. So I think that it was noted that a lot of that institutional decay that we saw through the Zuma years, it is noted by the rating agencies that is being turned around. So I think for a lot of the rating agencies, they are waiting to see whether the change in the institutional environment and the political leadership can actually turn can assist South Africa to turn a corner and growth, start to see growth increase. And really that all comes down to Eskom. If we can get Eskom to start providing a sustainable electricity supply, then we can turn that corner. So I think unless that hope fades, so and if rating agencies start to lose hope that South Africa can recover to a 2 to 3% growth rate. At the moment, most of them have us at around 1% over the forecast period. So that I think is behind their negative rating actions, is the low growth outcome. So I think if we would need to show growth picking up to around 2-3% to start to see South Africa move away from that the edge, the cusp of moving into a single B. Basically, if we carry on our current growth path, it's a matter of time before we move into that single B area. We'd need to turn growth around. And none of them are predicting that right now, but I think they're waiting to see how it turns out.